As an investor, the world and the economy can often be a very confusing place. Everything's always changing, everything's going up and down, seemingly at random. But what if I told you this is all following a very strict pattern? And if you know this pattern, you can exploit it to earn great returns on your investments. To explain this, I'll first have to explain the concept of market cycles. Basically, the first stage in the cycle is a depression. This is when the market is very low and stock prices are low, profits that companies are earning are low, and pretty much everything's just downbeat. Everyone's thinking, oh, the market's terrible right now. The general economy is terrible. No consumers want to spend money. So everything's just staying very low key. And then we get to our next stage. The next stage of the market is when things get slightly better. This is when profits of a company improve just a little bit. The economy improves just a little bit. The amount of consumer spending improves a little bit, but noticeable enough. And this is when the intelligent investor invests. This is when they start buying up stocks, which leads to a rise in stock prices. The next stage is when the general public become aware of the fact that the economy is improving. Profits of companies are amazing right now. Stock prices are insanely high. So all the public just buy into the stocks, which causes the PE ratios to go way up and stocks to become completely overpriced. But nobody notices because this is a boom. Everyone thinks everything's going to stay like this. Everything's going to stay good. And so competition starts to increase as more businesses try to get into the business whilst times are good. And more people invest. Everyone's investing. The next stage is when smart investors realize, oh no, PE ratios have gone way up, stock prices have gone way up, and there's nothing to base it on because the only things that is happening is more competition being introduced to the market. So then intelligent investors start to sell, which slowly filters through to the rest of the consumer base who like, oh, things aren't actually that great anymore. And so they sell, causing a massive crash in the market because everyone's dumping their stocks, which leads to prices going way down into the doldrums. And then, of course, we're back in the depression. So, you can see this in real life too. For example, 1999 and 2000 were massive booms in the US because everyone was investing in these tech stocks that were coming up. But then, slowly, prices became higher and higher and absurdly placed. And then people slowly started to realize, after these prices had risen so much, that, oh, it's not such a great investment. And then confidence wavered. And then it disappeared altogether. And stock prices crashed. And then they had a depression. But then, as usual, stuff started rising again until the 2008 financial crisis. So really, this pattern that I've described to you repeats yourself in everyday life. Every few years, you get a boom and a bust and a recession and a rise of stocks. So if you know what's happening in the market, you can time it well, whether to sell or to buy. Because as an intelligent investor, unless you're dollar cost averaging, which I'll explain in a future video, you should only be buying on low markets, so the depressed markets, or when markets are still rising. You should never buy when PE ratios are way too high, when you're in the boom, because this will only lead to failure in investing. I know this video was a bit convoluted, but if you did enjoy, please do consider subscribing and also liking this video so I can push investing to more people on this algorithm of YouTube. Anyway, thanks for watching and I'll see you next time. Bye.